transactions. Okay, so we're going to begin to record business transactions. You'll be doing this every chapter for homework, quizzes, exams, things like that. So let's give you some good solid fundamentals. First of all, what is a transaction? Okay, it's an event that affects the financial position of a particular entity. It can be recorded in a reliable manner. Every transaction impacts at least two items. Every transaction impacts at least two items. For example, if you purchase supplies for cash, cash goes down, supplies goes up. Two items are being affected. And the next item, number 4, is that the accounting equation balances before and after each transaction. So, the transaction affects the financial position. It could be recorded in a reliable manner. Every transaction impacts at least two items. An accounting equation balances both before and after each transaction. So, why don't you open your textbook to page 41 in chapter 1. We're looking at problem 133A. Chapter 1, page 41, problem 1-33A. Okay, so first thing you do is to look at the requirement on an accounting problem. So we'll go right to the bottom. Analyze the effects of the preceding transactions on the accounting equation of GAAP. And we're going to adapt the format similar to that back on Exhibit 1-8. Okay, so let's see. Marilyn Manson owns and operates a public relations firm called GAAP. The following amounts summarize her business transactions on August the 31st of 2011. She had cash, accounts receivable, supplies, and land, okay, which totaled $17,000. Okay, you can draw yourself an imaginary line between the assets and the liabilities, because the top of that right there represents the accounting equation. For liabilities, she had $4,000 in accounts payable. He had. And he had an investment in the business representing $13,000. So you can see that the 4,000 plus 13 equal 17,000. The accounting equation is in balance. Okay, so during September, the following transactions were taking place. Letter A, the owner invested cash of $10,000. Okay, so is it a transaction? Yes, it is. What happens is that the cash is increasing by $10,000. Okay, and Manson's equity is increasing by $10,000. So after transaction A, we're going to increase the cash to $12,500 and the owner's equity to $23,000. The assets went up $10,000. The liabilities and equity went up $10,000. Letter B, we performed services for a client and we received cash of $1,100. Okay, so cash is coming in, that'll go up, and Manson's equity will go up because we know that revenue received from a customer represents an increase in equity. So there's transaction B. Cash goes up, equity goes up. Letter C, we paid off the beginning balance of the accounts payable. Well, the beginning balance of the accounts payable was $4,000. If we're going to pay it off, then this cash amount is going to decrease by the $4,000. So for transaction C, we will have a $4,000 reduction in cash, a $4,000 reduction in the accounts payable. Assets are at $24,100. Equity and liabilities are at $24,100. Letter D, we purchase supplies from Office Max on account $700. Okay, so supplies are going to go up by $700. Okay, and if we're paying for them if we're buying them on account, then this accounts payable is going to go up again by $700. Okay, and there we see it in transaction D. Of course, the assets increased by $700, the liabilities increased by $700. Letter E, we've collected cash from a customer on account. Remember earlier I said accounts receivable represents monies that are owed to us by our customers. So if a customer is paying us $600, then our cash is going to go up $600 and our accounts receivable will go down by $600. You'll see at the bottom here the assets and the liabilities are still in balance. Letter F, we received cash of $1,700 from the owner. If we're receiving cash, cash is going up $1,700. His equity is increasing by $1,700. For letter F. Balanced, balanced. Letter G, consulted for a new band and billed the client for services rendered $4,300. Okay, we're providing services, so we're going to have revenue of $4,300. Okay, and in the fact pattern it says we billed the client. If we billed the client, we didn't receive the cash yet, we're extending them credit, therefore accounts receivable will increase by the $4,300. $4,300 receivables goes up. On the other side of the equation, $4,300 in Manson's capital increases. Letter H. Okay, recorded the following business expenses for the month. We paid office rent, $1,000. We paid advertising, $300. When you see the word paid in accounting, that means cash is going out. That's a cash outflow. $1,000 for the rent and $300 for the advertising. His capital is decreasing because we saw earlier that expenses reduce the capital balances. Of course, since we're reducing both sides of the equation by $1,300, the assets and liabilities and equity are both going to go down by that $1,300. Letter I. Returned supplies to Office Max for $100 cash, which was the cost of the supplies. Okay? Now remember, we purchased the supplies by using an accounts payable, but we're making a return and they're giving us cash back. So the supplies are going down $100, the cash is going up $100 for letter I. Okay, there's no change in the payable. We still owe them $700 because we took the return in cash. And lastly, letter J, the owner withdrew $2,200. This is a withdrawal that we saw earlier as part of the capital equation. The withdrawal means he's pulling out $2,200 in cash. If the cash is going down $2,200, on the other side of the equation, what's going to go down? That's right, his capital will decrease by $2,200. So after transaction J, our assets total $27,300, our liabilities and equity add up to $27,300. The accounting equation is still in balance.